Hi traders, welcome to Market Outlook, Trends, Risk, Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. So I just let you have a look at the disclaimer. I'll just run through what we hope to get through in the next half hour, 40 minutes or so. We'll follow the usual format actually, so we'll just see how markets are shaping up currently to kick off the week into month end. We'll check out what Fed funds futures are pricing for the Fed going forward, and this theme around rates being higher for longer, which we've been talking about for quite a few weeks now. We'll check out the dollar index, the DXY, and also of course stocks, the major US indices at key juncture actually, a couple of them, the S&P 500, NASDAQ, key a confluence really of key support levels really that we're touched on Friday. So we'll look at those. We'll then preview the ISM data, as well as looking back actually briefly at the Fed minutes, just to tie all that up. And then we'll go into the Bank of Japan and the dollar yen, which is getting obviously a lot of headlines with the new governor Ueda, who has been speaking last week and is due to speak this week as well. And then hopefully we'll wrap it up with a look at euro dollar. We'll look at review the PMIs from last week, and then we get Eurozone CPI data actually this week as well to check out. If we do have time, we'll look at sterling as well. So cable, small bid to the pound this morning on a potential news for a Brexit deal. Okay. So we start off with the year-to-date performance chart actually of the majors. And we can see, dollar strength now to the fore really, and still the Kiwi dollar actually and the Japanese yen, the weakest performing majors at the moment. The week's focus for the next few days will remain on geopolitical developments, which we'll talk about, some slight faltering in confidence in the China reopening narrative, and then we also get some data. We get the ISM surveys, as I said, the manufacturing and the services on Wednesday and Friday respectively, because we don't get the key US employment figures until next Friday now. So normally the first Friday of the month, but just because we're the 3rd, it will be on Friday, the 3rd of March. Then we actually get non-farms on the 10th. As I said, we get Eurozone CPI flash data. We had a revision last week to previous months. And then we also get the ECB minutes actually, as well as the slew of Fed speakers, which are on tap, numerous speakers on tap this week as well. I think will be ECB speakers as usual, but the much stronger than expected US PCE inflation data on Friday kind of spooked markets again, and that really sort of took the Fed's terminal rate for this year higher, really with discussions of the risks of larger hikes now being talked about. Again, it's this higher for longer theme that I've just talked about, really have been talking about for weeks really now. That's dominating price action. Money markets, they've raised the terminal rate, that end rate for the Fed funds futures to 5.4% now. So close to 5.5%. Base case really is for 3 25 basis point hikes. That's in March, May and June. Though the odds for a 50 basis point March rate hike are now slowly increasing. And in fact, if I just take you to our favorite, one of our favorite websites, the CME Group Watch site that we talk about a lot, and that just has, again, it shows what futures markets are pricing in for each Fed meeting. This you can see is for the 22nd of March meeting. You can see we talked about it last week. Just this increase now in potential for a 50 basis point hike on the 22nd of March. You can see if rates were to go to 5 to 5.25%, remember that range, that's gone from sort of nothing a month ago, not at all priced in a month ago, now to 31% or so chance that futures traders are giving to a 50 basis point rise in a few weeks' time. You can see even from last week when we spoke, when it was probably around the 20% mark, I think, 18% on the 17th of Feb, got up to sort of 20 or so, I think, from memory last week. Now we're up to 31%. So really, really big move in bond markets, really, in treasury yields, driven by all this data that we've talked about, PCE data on Friday, especially a big mover for rates markets. And in fact, if we just go, it's always good to look at what's priced in for further out. I said that terminal rate is around 5.4%, sort of middle of the year. And if we just look at here, so this is, sorry, let me just go back. This is for the 26th of July meeting. You can see there. Then we have quite a big break actually until the next following meeting. That's on the 20th of September. So a couple of months really nearly between those July-September meetings will be interesting. But you can see there now a 33% chance, so 1 in 3% chance rates go to between 5.5% and 5.75%. And if we then look at historically where that was, yeah, definitely not priced in at all. Even the 5.25 to 5.5, you can see barely priced a month ago. And then you can see how this is all flipped over, if you like, where rates really, say a month ago, 50-50 chance or so that we would get, if you remember, around the 4.9%, I think it was, consensus thought we wouldn't go above 5%. That was a sort of coin toss chance a month ago. Now completely priced out, and the market's really expecting sort of 5.25 to 5.5%. As I said, peak rate around 5.4%, I think, if we delved into it into more detail. But yeah, again, you can see the big change in markets, and therefore that's obviously underpinned support for the US dollar. I do like to go to some of the treasury yield markets, or the bond markets, if you like. And last time I think we showed you the 2-year yield. So that's a 2-year treasury yield that closely maps Fed funds futures, as I've said. That took out the November cycle high at around just below 4.8%, and closed the week. You can see very strongly, that's today's price there, but even Friday, yeah, closed the week very strongly, 4.84%. So a new cycle high there. That's on the 2-year treasury. It's actually the highest, I think, since 2007. And then if we look at the 10-year yield, so that's sort of a proxy, if you like, for global borrowing costs. That as well closed very strongly near its highs, 3.978% or so. So very close to the 4% marker, and took out resistance. If I just go to the daily, actually took out, yeah, sort of hanging around resistance there at 3.94%. So interesting level. That's for the 10-year US Treasury yield. You can see really steady series bullish trend in that yield. So bonds going down, yields going up. And you can just see how we've consolidated below 4% and potentially looking to push above that key psychological level. Interesting then. And if you do follow this, then obviously then pretty much, you know, give or take, of course, but the dollar will then follow this trend up, and then risk markets will struggle, certainly. If we just now look at the DXY, actually, I'll just mix it up. We'll go to this first up. And you could see again pushed higher after that PCE data. So to new cycle highs, very close to then the year-to-date highs as well. And it's just a touch offered, as you can see today, but certainly finished, as I said, on a firm note last week, strengthening against all its major currency peers on Friday, up for a fourth consecutive weekly gain. Actually, we've not seen that since May of last year. Let me just show you here. Yeah, 4 weeks of gains, not seen that since here. Look. In May of last year, and interesting, actually, we're just on those sort of just pushing around those highs now from May of last year. But if we go to the daily, this is the DXY chart. You can see then, as well as obviously these hawkish Fed perspectives that everybody's focusing on, we do actually get positive seasonal patterns for the dollar. They're being talked about too as underpinning support really for the greenback and potentially for further gains, which is obviously corrected then some of this late 2022, obviously early 2023 decline. So potentially those seasonals being talked about as as I say, a sort of underpinning of support for the greenback. Really looks like sort of minor dollar dips are really being seen as a buy, and then technical signals really suggesting a well-established bull trend, as I've said. You can see there, especially on the short-term charts. Broader gains in the DXY, they may extend certainly for another few percent in the next few weeks then. The flip side, I guess, to that is that dollar's general strength is the likelihood, of course, of these further rate increases, potentially then, as well as in the US, then we do get further rate increases in Europe and Asia Pacific in the next few months. And then we do have sort of look further out, we have longer run headwinds for the dollar, which remain in place. Via market pricing, really, most seeing the Fed will eventually cut earlier than, say, the ECB, which is on a hiking path. It's probably the Fed is coming to their hiking path, certainly still seen as earlier than the finish of that path, earlier than, say, the ECB, which may have to keep rates higher for longer, even than the Fed. That's kind of consensus at the moment, and rates potentially staying at their highs, which we'll get onto shortly, for the ECB for longer than, say, the Fed, which will need to cut. As well, focus is turning, interestingly, to then the possible hawkish changes to the next dot plot that we get at that Fed meeting on March 22nd. That's their next meeting, as I pointed out with that CME Fed Watch Tool website. We've obviously had numerous speeches by Fed officials this year, generally suggesting that the median expected policy rate peak for this year will be lifted compared to December. Cast our minds back to the December Fed meeting, and the current median peak rate was seen at 5.1%, I think, 5 to 5.25% by the end of 2023. Although already you had 7 out of 19 governors expecting it to be at least 25 basis points higher than that. So there'll be a lot of focus on these updated projections, which potentially will also then dissuade investors, if you like, from re-entering dollar shorts in the run-up to the Fed meeting, that meeting 22nd of March. And at the same time, you might have read about it, heard about it, then this yield curve inversion. So that's the 2-year yield, Treasury yield against the 10-year Treasury yield. That's now inverted the most since the mid-1980s, Fed's Paul Volcker, when he was in tightening mode. And then that really creates a headwind to risk assets as well. It does point to a recession, as we know, as you probably know, and then it's potentially hard to see how global equity markets really push that much further ahead, really, until there are clearer signs that, of course, the Fed, other central banks potentially are then easing off. And we've sort of had this conversation, if you remember, sort of back end of last year, when obviously we all hoped for this, or a lot of people hoped for this Fed pivot, that relenting in their tightening cycle, and then potentially that impacting on, of course, the dollar, which it did do. And then we've had this about turn, of course, with all this data, positive data. For equities then, well, futures, I'm just looking at futures actually pointing higher actually to start the week, but that comes after. There's futures up 0.5% or so in the S&P 500, NASDAQ up 0.59% for the futures. But this comes after Wall Street actually recorded its biggest weekly fall in more than 2 months. Friday declining further on Friday, actually after that high inflation data we've talked about. S&P closed down 1.1%, bringing its losses for the week to 2.7%. The tech-laden NASDAQ, that was down 1.7% on the day, 3.3% decline for the week. Those weekly declines then were the sharpest since early December. And US stocks actually have now declined for 3 straight weeks after this unexpectedly really strong start to the year. Definitely interest rates are having an impact. Higher rates, of course, for an extended period of time. They put pressure on equity valuations. We've talked about that before, and especially tech valuations. And we've been saying about how central bank officials, of course, have repeatedly warned about these higher rates for some time, but really the market wasn't listening. We've written a lot about that in our daily commentaries. And really markets haven't been listening until, of course, this long stretch, if you like, of recent data, which has suddenly kind of convinced them. And we've had, as I said, strong labor market data, of course, CPI data, retail sales data, among various others, really turning the tide, if you like, and putting some pressure on the risk rally on stock markets, essentially. If we just look at the S&P technically, then this is the weekly chart, the S&P weekly chart. We sort of highlighted these sort of consolidation candles, if you like, dojis, inside candles. So sort of the range is printing inside the previous week's candle on a couple of occasions, potentially sort of bullish consolidation, but sadly we couldn't get above that halfway point of the 2022 decline, if you like. That was at 4155, that halfway point, and a couple of times you can see failed to close above there, and then we've rolled over, turned lower. So interesting, really. Now we're at where are we? We're at well, resting on that long-term trend line resistance, which has now turned support, of course. We also have now turned lower into the next fib level, which is at just below 4,000, 38.2 fib level, that is, as well as then the 50-week moving average, that light blue line, just above 4,000 at 4,011. So critical juncture, you'd have to think, for the S&P 500. And as well, just to cap that off, you have the 200-day moving average, which we tapped actually. You can just see there on Friday, we tapped at 39.43, the low. Actually, the 200-day moving average is now at 39.40, you can see there. So, yeah, critical level of support for the S&P 500. If we do bounce, then obviously then we get into sort of that 50-day moving average, initial resistance potentially before getting back above 4,000 and then looking at levels above there. Otherwise, if we do fall lower, then potentially we're looking at where we're looking at sort of 39. Where are we? The sort of 100-day moving average is actually then below that 200-day at 39.14. Otherwise, then we fall back towards sort of this December noise, if you like this December range above 3,800. For the NASDAQ, let's just pull that chart up. Just have a look at the weekly. We can see the breakdowns sort of fall down below the 50-week moving average at 12,226 there, and just to fall below down to a couple of halfway big sort of fib level. Actually, you can see from the pandemic low, actually. So that rally, the halfway point of that is at around where 11 11,768 or so. So potentially a level of support, as well as then that falling trend line, as well as the 200-week moving average. That's on the NASDAQ 100. The 200-week moving average is 11,658. And then similar to the S&P, you've got the 200-day moving average, which we tapped, as I said, like the S&P, but also on the NASDAQ 100, that's at 11,904. So again, big levels of support potentially should hold. Otherwise, we go lower, and then we're falling down towards sort of 11,715, 11,500 or so on the NASDAQ. Just on the Dow, we highlighted, let's go to the weekly, highlighted this before, that August resistance level at 34,281. Couldn't break above there. Tried on several occasions. You can see, just pull that up as well. More we track sideways, the bigger the range breakout. And it wasn't to the upside. We've rolled over. So potentially, we said it would happen quite quickly. And we've fallen sort of now potentially to the bottom of, well, the December low is at 32,573. You've also got that 50-week moving average, the light blue line at 32,666, as well as then a sort of near-term fib level around where we are actually at the moment. So again, interesting levels potentially. If you go to the daily, then probably that range low is at 32,581. And then you have the 200-day moving average below there at 32,346. So interesting levels, key levels for some of the main US indices there. Massive support, really. Be interesting, really, what happens this week. We normally do look at the DAX and the UK index as well, just to point out the DAX really looked weak, but sort of back into its range. Looks like sort of bullish consolidation really there. If you can see that nice uptrend, sort of tapped the lows and then have bounced quite nicely. We're above a sort of near-term fib level there, so potentially that resistance now is at the recent high 15,656. Again, sort of looks like potentially bullish consolidation if we can keep above sort of 15,000. Well, the low really from this week, 15,198 potentially. And then the UK FTSE, interesting as well, just sort of tapped that trend line support, really just about, kind of depends where you draw it, but yes, looked like we were rolling over potentially, but no, we've seen a bid today, decent bid today, touched that sort of trend line support, if you like, and bounced up, as well as that long-term low, which was high, which is at 7,903 back in 2018. You can see there that dotted line, and we're above there now. So looking, yeah, you can see that long-term trend line, 7,903 as well, the dotted line. So if we can hold above here, then potentially we look at these recent highs above 8,000. That's in the UK FTSE 100. Okay, next we'll just briefly look at one of last week's main events. That was the, well, yeah, it's worth touching on the Fed minutes from the February meeting. Kind of reflected this balancing act really facing policymakers everywhere, if you like, supporting the outlook for higher rates, of course, amid upside risk to inflation, but then also, of course, noting downside risks from the tighter policy, which is obviously what they're trying to do, just to rein in demand. Obviously, then we go back to the soft, hard landing scenarios. But at the moment, yes, this is from the minutes, obviously, back in February. So obviously, we've had this strong data since, so slightly stale. But really interesting, nearly all policymakers supported the 25 basis point hike, but a few, in inverted commas, if you like, so perhaps more than just, say, Bullard, Mester, favoured more aggressive hikes. A number of participants also observed, actually, that a policy stance, excuse me, a policy stance that proved insufficiently restrictive could halt recent progress in moderating inflationary pressures. So kind of another sign that the Fed would rather implement a rate hike, more rate hikes really than, say, stopping too early. And then a final passage worth mentioning actually was about that one around financial conditions. Given obviously Fed Chair Powell's somewhat kind of off the mark remarks on the topic at the Q&A session, if you remember, suggestion that they had tightened, despite, of course, what's weakening financial conditions mean, weaker dollar, yield correction, stocks surge. So some officials at the meeting observed that any continued easing actually in the financial conditions could require the Fed to raise rates to higher levels, or at least keep them higher for longer than anticipated, which is kind of what the market was thinking, but sort of Chair Powell had sort of batted back against that, or at least he was more relaxed about them. So interesting there. A couple of points from the Fed minutes. Overall, they supported the prospect, of course, of this extension a bit beyond where many assumed the peak would go. And over the last few weeks, certainly it means, well, we've seen again, it hasn't, those minutes didn't reveal that much that we didn't know already. In fact, now with the numerous Fed speakers, of course, singing from the same hymn sheet, if you like. For this week, then, the macro highlight will be those ISM business confidence surveys, that data. The manufacturing, as I said, released on Wednesday. Just let me pull up a chart, actually, which you've got here, improving ISMs. Manufacturing on Wednesday, that's expected to improve modestly, only modestly actually in February, still below 50, so still sort of denoting contraction. Contraction. You remember the 50 above is expansion, below contraction, but some economists think it could pick up in the next few months with a rebound in industrial production, which has kind of been at this trough recently, but expected to pick up in the next few months. You can see here then manufacturing in the lighter colored line, so below 50, which is here. And then non-manufacturing, that's probably going to be the more interesting one potentially. That's the services ISM, that's on Friday. You can see we were below 50 and then rebounded strongly to around, I think 55.2 was the last reading from 49 something, I think, from memory. So that picked up, but that might be more interesting because it was weather related. And certainly there's various economists, I think, on Wall Street just sort of mentioning the fact that potentially a lot of the really good data we've seen recently is around this weather, better weather that we did see in the US in January. And there's questions around whether it's solely weather related or whether actually it reflects sort of better optimism and an underlying strength in the US economy. So certainly then that might be interesting on Friday, could set the trend for US data actually going forward as well. And as we know, of course, the Fed we're all data dependent at the moment. Also kind of think that we've had all these bumper upside surprises, actually, if you like, in this data. So potentially what happens, I kind of think what happens then if we do get any downside surprises, really, which is kind of ruining the theme of those upside surprises, if you like, going forward. There's other data as well, actually, out of China could be interesting. The PMIs on Wednesday, strong showing there, certainly could provide some support to some of the activity currencies. So those cyclical currencies like the Aussie dollar, the Kiwi dollar. But certainly as well, we have to remember, as we mentioned at the top of the webinar about geopolitics, Sino-US relations certainly sort of turned a corner, sadly, in a way, deteriorating, really. The US believes China is now arming Russia with drones. And then we've also had this 12-point peace plan proposed by China, which has apparently taken a clear anti-West stance, really condemning NATO extension and sanctions against Russia. But that said, the Ukraine president, at least Zelensky's kind of signaled that he's slightly open to this plan potentially, and also then meeting the Chinese president. So really keep your ears out for headlines around this, which is sort of been bubbling under, but now sort of come to the surface. So yeah, that might guide markets as well. And certainly the dollar then will get a safe haven bid if that sort of tension increases markedly. I wanted to touch on dollar yen now, actually, because we've heard from, as I said, Governor Ueda. If we just bear with me 1 second, whilst I just get the next chart, actually, which will be dollar yen. But yeah, we've had a lot of attention on the Bank of Japan governor nominee Ueda. He appeared on Friday for a parliamentary hearing, actually in his first public remarks since his appointment to replace the current governor Kuroda at the helm of the BOJ, of course, when Kuroda's term ends in April. So Ueda kind of managed to keep pretty balanced approach, kind of what was expected in the end. Obviously, initially, there were hopes for him being more hawkish, but now he's been pretty balanced. He said the central bank's current easing is appropriate, while simultaneously, stating the obvious, really, that the Bank of Japan will inevitably have to think about a review of its uber dovish yield curve control policy, or at least move in the direction of policy normalization if there's another clear step up in improvement in the outlook for inflation, if that comes into sight. Markets certainly, as I said, they've been pondering about the timing of this watershed moment ever since the BOJ actually unexpectedly, if you remember, in December doubled the tolerance band around the 0% target for the Japanese government bond, the JGB 10-year yield, from 25 basis points to 50 in December, as I said, last year. It kind of seems it does become harder for the BOJ to turn a blind eye to some of these inflation dynamics. We had that on Friday. The January national inflation figures, they showed headline reading rising to from 4% actually to 4.3% year on year, while the underlying core inflation figures, they accelerated to 4.2% from 4%. So both the highest levels since the early 80s, more than double the BOJ's inflation target. So really putting pressure potentially on policymakers. I think we get Tokyo CPI out end of this week, always a guide. I think we're in wage negotiation sort of territory as well, season. So that will be interesting because that kind of contrasts against Kuroda's stance actually on inflation, which kind of he views as being or remaining cost driven actually, and it probably peaked last month as government support measures sort of kicked in. So contrasting really with what the market's kind of wondering whether then we get this policy normalization going forward. For the yen, yeah, certainly there's been volatility. We popped high. You can see this green candle here on Friday after the inflation data. And for this pair, really, dollar yen, you kind of think on the one side, you've got the greenback, which gets interest rate support, with markets really discounting higher rates for longer generally. And then on the other hand, it probably remains too soon to front run, if you like, the U-turn by the Bank of Japan. So dollar yen sort of changed this long-term downtrend that we had seen, obviously, from that October high, remember, above 151. And then we've had this nice change, and a sort of switch, if you like, now a series of higher highs, higher lows. And then, as I said, that pop higher to year to date, broke the year to date high, and we're back to sort of December level, if you like. December levels around 136, above 136. Fib levels here, you've got the 38.2 at 137.24, and that tallies with then the 200-day moving average and the 100-day moving average there crossing over potentially. just above 137, 137.05, the 100-day, 137.11 for the 200-day. So interesting, really, whether we can get up to there around the 137 mark or not. That's in dollar yen. Otherwise, if we just come back, then you've got obviously support around here, around sort of 134.50 or so. Okay, that's dollar yen. Let's go to euro dollar now. Eurozone sort of data. We had a bunch of data out of last week, the PMIs, if you remember, and then a couple of business survey numbers out of Japan. The preliminary PMI data from France was broadly higher. Germany data decent. Manufacturing slightly weakened, but then the Eurozone services and composite, they both handily beat estimates. We also then had the those German surveys, as I said, the ZEW, that improved. And in fact, expectations were the strongest in a year. And then we had the IFO survey data that was a touch stronger than it forecast. Expectations component rising. And it kind of then all this sort of data from last week, pretty solid, suggesting trends are moving in the right direction. Probably not quite out of the woods yet. But the economy generally looks to be in better shape, of course. And it kind of probably gives the ECB hawks at least a bit more sway potentially over policy decisions in the weeks ahead. We did actually have Eurozone final headline CPI data, which was revised slightly higher, 8.6, I think, from 8.5. And then core prices revised up a tenth. Actually to a new high for the move, up to 5.3%. Ties in actually, excuse me, with then we get the flash estimate on Thursday for the Eurozone CPI data. That certainly will be a highlight. Expectations actually now for that 8.6 figure in the headline to fall to 8.1%, I think analyst estimates are. But with the core reading remaining steady, sticky at 5.3%. Certainly recent releases in the CPI data, they've seen kind of analysts focusing on that diverging trend between the headline obviously falling, core inflation moving, well, sticky, at least moving higher. The headline falling due to declining energy prices, whilst certainly the core continues to rise, really sits, as we said, well, that's an all-time high actually for the Eurozone of 5.3%. That is what ECB policymakers will focus on, the core sticky reading. And really it gives little reason then for markets then to change their current pricing, which I think is now around 130 basis points of further rate hikes. So that means a 50 basis point hike as signaled by Lagarde, if you remember at the previous ECB conference, press conference. So 50 basis points nailed on for the 16th of March ECB meeting, sorry. And then, 80 basis points further out, which means a peak in the depo rate around 3.75%. Just thinking about ECB speakers, they were kind of mixed recently. We've talked about this before, actually, just generally how you'll obviously get this competing view between the doves and hawks. Friday, for example, we had hawkish Schnabel saying investor risk is underestimating the persistence of inflation. That kind of bolstered rate hike bets, if you like. But then later we had more dovish Villeroy, who kind of said the rates are now in restricted territory and that they may raise above 3%, but it's not automatic. So kind of to be expected. But as we said, with the data being quite decent, then potentially the hawks get more sway. For the euro dollar, then you kind of would expect some support, but at the moment it's kind of dollar strength, which is winning out. We did lose this key support level for us, which was 106.10 in euro dollar. And the breakdown of that really extent means that we're, potentially looking at the lows here, the low year-to-date low actually 104.81 potentially, even though we got a slight bid this morning. So that is a key level to look out for in euro dollar. Otherwise, potentially we need to get about above 106.10 really to look at sort of 106, 107 region. But at the moment, doesn't look good as long as this 106.10 level keeps, we keep below there. So that's turned resistance. Just briefly, we'll touch on sterling. Got a little bit of a bid today on this improving trading and political relations between the UK and the EU. Potentially later today, there are expectations kind of building that a deal. I haven't seen anything on the wires this morning, although I've been quite busy, but I hope I haven't missed anything about, yes, these expectations building that the deal will get announced between the UK and the EU to soften the trade barriers basically on the Irish Sea. Interesting whether then we or there is a sufficient move, in fact, to get the DUP party back into government in Northern Ireland. How much improved, obviously, UK-EU relations further out, how much that helps sterling. Yeah, potentially with obviously this better trading environment between the UK and EU. Yes, potentially, not sure how long that lasts, or certainly how long the sterling support lasts. ECB, as we said, in hiking mode. Bank of England probably coming towards the end. If you remember, they started the earliest, and then potentially for cable anyway. So sterling against the dollar, potentially vulnerable to continued dollar strength. Much will certainly rely on this ISM data. There's very little UK data out this week. And for the Bank of England, well, markets are fully priced for a 25 basis point hike in March. And it's kind of building sentiment for the policy rate to rise actually above 4.5% over the summer. So that would mean another quarter basis point rate hike after March as well. Technically then, yeah, we said nice to see a bid in cable pushing up towards 120. You've got the 200-day moving average, which looks like decent support, as well as that 100-day moving average just below 120, so 119 sort of 47, 119.24. So there's an area there of support. But if we do lose that, then we have that near-term level, 119.14. Otherwise, then this year-to-date low is at 118.41 potentially. Bulls, buyers, I think we need to get above sort of 120.50 area to then get back into this mix and push then against that sort of near-term resistance trend line level. Okay, I think that is all we have time for today. Hopefully you've enjoyed that and got something out of it. And we look forward to speaking to you same time next week. Okay, take care out there.